Richard Mathieson. Thank you so much for taking the time this morning. I've got a brief version of your bio. I'm going to link the full thing in the show notes, but I think it's important for people to know that you're a managing director and member of, this one's a tongue twister for me for some reason, BlackRock's Systematic Active Equity Investment Group. I got it right. You're a portfolio manager responsible for global equity strategies, and I think that's a pretty natural segue into why your expertise is relevant to what we're going to talk about today, which is this news headline that we're seeing more prominent today that pops up every so often, the de-dollarization conversation. And really where I want to start, and I'll let you riff on this topic, is what does it mean to be a global fiat currency? The United States dollar is the global fiat currency right now. Maybe give us a sense of what a fiat currency actually is and a brief history of how the United States got there.
Yeah, sure. So first of all, thank you so much for having us, Jordan. It's a great topic and yeah, something that we've definitely been looking at. So the US dollar has been the world's fiat currency, or I would call it the reserve currency, since the end of World War II, and the undisputed global reserve currency really since the end of the Cold War. Now, what that means is there's a disproportionately large amount of global trade that is priced in dollars. The best example of that is hard commodity markets, many of which are solely transacted in dollars. And what that means for pretty much every country around the world is useful, if not vital, to have very large stores or reserves of US dollars in order to mitigate exchange risk and mitigate the need to continuously be translating your own local currency into dollars in order to trade. In short, the whole topic of de-dollarization is the sort of theory that over time that is likely to change. In new currencies will become available, and ultimately the dollar will lose its prominence and lose its importance in world markets. And a lot of the dialogue, debate, conversation is what that could mean for the US dollar and the US economy and US policy.
So to set the context, before we even discuss whether or not this is a real threat, a material threat imminently, do you have any sense or can provide any sense of how significant the US dollar's role is right now in the global economy, whether it's proportion of reserve currencies in central banks,
Yep.
whether it's transaction volume, that sort of thing?
Yeah, I mean, I think it has been trending down over time. And again, the dollar has had this status since 1944 in part. So we're talking about an 80-year life cycle,
Yeah.
but it still is by far and away the most important currency for global trade and global reserves today. So in terms of share of foreign asset reserves, it's around about 60%. In terms of cross-border payments, engineered across SWIFT, it's around about 40%. And there's no other single currency that's anywhere near it. The closest would be the euro. That's about 20% in terms of reserves, and more like 35% in terms of transactions. But that is very much flattered by the fact that a lot of that activity takes place, between actual European countries in the single currency region. So, by far and away the most important currency, euro somewhat coming up behind it. But if you go beyond that, no single currency, thinking yen, sterling, renminbi, those are all very low single digits and very unimportant in the global scheme currently. So, it is by far and away, the world's reserve currency and continues to enjoy that status.
That's really helpful. I think that's helpful for everybody to understand the context. As part of this de-dollarization conversation, we hear about countries like China, Russia, Iran, Saudi Arabia, even some South American countries are starting to become front and center in this conversation. If you could put yourself in the shoes of a policymaker in one of those countries, an investor or a business owner in one of those countries, what are some of their motivations for wanting to diversify away from the dollar?
Yeah, absolutely. And why we're talking about this and why this has suddenly become a hot topic currently is largely down to the Ukraine conflict and the way in which the US government have somewhat weaponized the dollar in imposing fairly aggressive sanctions on Russia. And so, we know that, yachts have been seized, planes have been grounded, but, billions of dollars worth of Russian-owned assets have been blocked, and the US has ejected Russia from the SWIFT payment system internationally. So, there's been a significant crippling of the Russian economy, largely as a result of its reliance on the dollar. And so you can imagine, any other country that is worried about the prospect of that is looking at ways to mitigate US jurisdiction in the monetary in the global monetary system, or holding alternative currency reserves, or even hard commodities that would enable it to avoid that risk in the future. So, Russia has been very much front and center of this effort. I would say, China would be one of the other key protagonists. But, as you alluded, they've been reasonably successful in influencing, other countries, other regions to coordinate and collaborate in a way that, individually doesn't look to have any real implications, but in aggregate, it paints a picture of a world, particularly in the Eurasian region, so Middle East heading east into Asia, that is coordinating in a way that could be seen as increasingly isolating the dollar. Some examples of that, for example, Chinese intermediated improving relationships between parts of the Middle East. Iran, Iraq are building a road and a railroad between the countries, two countries that normally don't historically have not got on well with each other. Similarly, the Saudis and the Iranians are swapping embassies for the first time in many years. So there's some very, very granular nuggets of collaboration going on there, also brokered by Russia and China. And taken together again, it could be seen as attempts to increasingly isolate the dollar in order to mitigate the risks of the US could pose in terms of its ability to wield sanctions.
So you alluded to this a little bit earlier, but I feel like we have to nip this one in the bud. Um, During the conversation of de-dollarization, the idea of the yuan or the renminbi replacing or usurping the United States dollar's role as this global reserve currency continuously comes up. Can you just give us a sense of, you already provided a little bit as far as proportion of reserves and transactions in USD, and then euro being the second, but still far and away the second. Can you give us a sense of where the yuan slash renminbi falls just in global proportion of currency holdings?
I mean, it's low single digits in all honesty, and in trade, around about 3%. And again, like the euro, it's somewhat flattered by the fact that a lot of that trade is happening between onshore and offshore China, Hong Kong. So, the US dollar really, really is the dominant force. In terms of alternatives, again, thinking of painting this picture of lots of granular anecdotal evidence building up into a bigger picture. At the 2022 BRICS conference, Putin announced plans to develop an alternative international payments system using a currency basket, not just an individual currency. So a currency basket made up of the renminbi, the ruble, basically all the BRICS currencies. There's been talk in discussion about a version of something like that, or even a single currency like the yuan that is backed or pegged to hard commodities like the oil. But again, while that can be helpful, in managing currency volatility and currency risk, history suggests that running those types of pegs is actually very, very difficult. If you set it too high, if the peg's too high, you basically at risk of capital inflight into the local economy, the consumer spending too much in imports, which puts the current account under pressure. It's inflationary, and ultimately the peg collapses. And that was exactly what happened in the 70s, and why the original version of the dollar reserve currency, which was backed and pegged to the gold price, was abolished by Nixon. In the US had floating rates as early as the 1970s. Again, the Asian financial crisis was exactly the same scenario, where the peg wasn't to hard commodities, it was to actually the US dollar. And again, it caused all sorts of problems. And again, if I look at the Chinese economy right now, and they still peg partly their local currency, the yuan, to the USD. So the fact that they're still very heavily reliant on exports to US consumers, again suggests that it would be very, very difficult for them to suddenly walk away from that overnight and adopt a completely different system.
So you're touching on something super important right at the end there, the idea of making this change overnight. If I'm gathering all that you're saying and all that I've been reading and hearing, de-dollarization, we as human beings in 2023 want things to happen, or it makes sense for our mental models for things to happen over very short periods of time. When really what this sounds like is directionally, de-dollarization has been happening for a long span of time. That's just the nature of the global fiat currency system. There have been historical examples where over, again, a long period of time, new global fiat currencies, global reserve currencies emerge. Directionally, is that what you're saying, that we are seeing this phenomenon of de-dollarization, but it's been here for many decades and it takes many decades to play out? There's nothing imminent that's different today than there was maybe yesterday.
Yeah, I think so. I mean, again, let's take the bear case scenario for the dollar, which is, overnight or, in a very, very short period of time, these pockets of collaboration come together, a really viable alternative to the US dollar is presented, which means that none of these countries now need to have dollar reserves, and en masse, seek to remove those dollar reserves. And, so that would be, put downward pressure on the dollar in the first instance. It would put upward pressure on US yields as overseas holdings of US treasuries were sold down aggressively. And ultimately, it should play out in inflation to US consumers and businesses, predominantly through the fact that the US still runs, a current account deficit, whereby it is a net importer of goods and services from many of these countries. And, I have heard, some speculation and some commentators talk about, a tsunami of inflation that would send treasury yields soaring and ultimately all US denominated assets collapsing with correlations of close to one in sort of an end of the world type scenario. It really feels that is an overly sensationalized outlook. Attempts by all of these sanctioned currencies to find alternatives could well work as an alternative choice to the dollar. However, there doesn't seem to be any real immediate fast trend away from, most countries continuing to use the dollar as the reserve currency of choice. I mean, it's pretty much every country in the world has accumulated vast stores of reserves. It's still the most stable liquid form of exchange, backed by the largest economy in the world in terms of common currency, and it's backed by the safest paper of all in terms of US Treasury. So for all that to unwind very, very quickly seems, again, overly sensationalized. And if you look at just pricing in markets, the dollar price, if you look at the DXY right now, doesn't suggest there's an imminent threat. I mean, obviously it's rolled off the extreme highs we saw in 2022, but still remains comfortably above sort of long-term trading ranges. Similarly, if you look at treasury yields, it doesn't feel as if being the reserve currency of choice is playing out in access to abnormally cheap funding for the US Treasury. US Treasury yields, on average over the last 40 years have been comfortably above those for most other developed market bonds. So they're not pricing an imminent threat. And so if you put it all together, you don't see any sign of this in the pricing. And to be honest, even if it did happen, I would question whether it would have the impact on the US economy and US businesses that I guess the sensationals are projecting. First and foremost, the fact that yields have not been abnormally low means that there's not a lot of mean reversion to happen there. Now, clearly, lots of other things drive interest rates. But even if you did see a spike in yields, the US policymakers have enough ammunition to combat that with countervailing measures. So first and foremost, there could be measures that they can deploy to change that. Secondly, if you look at the actual level of foreign assets held outside of the US, or foreign debt that's held outside of the US, that has been trending down over time. It used 10 years ago, it was around about 50% of US treasuries held by overseas countries. Today, it's more like 40%. And it's actually not that much bigger than most other regions, the UK, Japan, Europe. So, it's not by and large the US is completely reliant relative to all other countries for overseas funding. And then the final point I would make in this one is the current account deficit. That's the main transmission mechanism for, the inflationary pressures that de-dollarization could ultimately cause domestically. And again, on average, over the last 40 years or so, it's been running at around about 2.25%. That's not actually a big number. It's entirely manageable, and it would be quite easy for the US to take steps to reduce that, or even flip it around. And as a case in point there, look at the concept of energy independence. The US today, a net importer of energy, having been a net exporter historically. It's a really good example of how the US has taken steps to protect its position and mitigate the risks of this type of scenario playing out aggressively in the economy.
So that's a nice, again, segue into the last question I have for you. If the base case is that this is a directional trend, but it's not a tsunami, a cliff, whatever we want to call it, and you put yourself in the shoes of a United States policymaker, economic advisor, treasury secretary, whatever it may be, what actions should the United States be taking if, again, the base case isn't we need to prepare for de-dollarization over the course of the next 12 months, but looking decades into the future, we want to ebb the flow of reserve holdings outside of the US dollar, transactions happening in other currencies, so on and so forth.
Yeah, I mean, I think it comes back to that, just, sort of good domestic macro housekeeping, keeping the local book in order. So, maintain, continuing to protect that current account. Onshoring would be a good example of another activity there that could be useful. We haven't talked about debt to GDP. Clearly it has been on an upward trajectory, but peaked in March 2021 at around about 132%, and has actually been slowly coming back down. Continuing to take that pressure out of the system. And then from a foreign policy point of view, I think managing selectively managing the enemy list. Whilst continuing to support allies, including the Ukraine, is clearly something that I'm sure is being talked about.
Well, fantastic. Look, I could talk about this, and I'm sure you could talk about it for a lot longer than I can, but I want to make this digestible for clients, and I think this is a great start. Hopefully we can continue the conversation as the situation unfolds. I really appreciate you taking the time. I think this was fantastic. I'm going to put this with all the links that I discussed on our page and send it out to all of our clients and post it on LinkedIn. But Rich, thank you so much for taking the time. This has been fantastic.
Thank you, Jordan. Appreciate it.